They printed more money than at any moment in human history. Trillions flowed into the system. Markets soared, rates collapsed. And yet, something went terribly wrong. Productivity slowed, wages stagnated, debt exploded, and growth quietly disappeared. This is not a story about inflation. It is not a story about recession. It is a story about a system that discovered its greatest weapon no longer works. When money becomes infinite, it stops being powerful. When liquidity is everywhere, progress is nowhere. This is the Great Liquidity Trap. And this time, money cannot save the world. The modern global economy entered a radically different phase the moment money stopped being scarce. For decades, capital had been treated as a limited resource, something earned through productivity, innovation, and risk. That assumption collapsed quietly, without a single dramatic announcement, replaced by a new doctrine in which liquidity became infinite by design. Central banks across the developed world adopted a single unspoken principle. Whenever growth slowed, whenever markets trembled, whenever confidence weakened, the solution would be more money. Not reforms, not structural change, not creative destruction, but liquidity injected at scale previously unimaginable. This transformation did not begin as recklessness. It began as emergency medicine. After the global financial crisis, policymakers faced the real possibility of systemic collapse. Banks were insolvent, credit markets frozen, trade chains fractured. Extraordinary measures were justified as temporary. Quantitative easing was presented as a bridge, a way to stabilize the system until normal economic dynamics returned. Balance sheets expanded, interest rates fell, and the immediate catastrophe was avoided. What was never fully acknowledged was that the bridge led nowhere. Temporary measures became permanent architecture. By the middle of the following decade, the balance sheets of major central banks had grown to sizes that would once have been considered politically and economically impossible. Liquidity flooded government bond markets, corporate debt markets, equity markets, and eventually even speculative assets. Interest rates hovered near zero for so long that an entire generation of investors, executives, and policymakers came to see it as normal. In several economies, borrowing costs effectively disappeared. Debt was no longer something to be repaid. It was something to be rolled forward indefinitely. At first, the illusion of success was convincing. Asset prices surged. Stock indices reached record highs. Real estate values inflated across major cities. Governments celebrated stability, pointing to low unemployment and resilient markets as proof that the new monetary regime worked. But beneath the surface, something essential was breaking. Productivity growth slowed. Capital investment became increasingly disconnected from innovation. Corporations used cheap money not to build capacity, but to buy back shares, inflate earnings per share, and reward financial engineering over long-term value creation. The world entered what could only be described as an age of monetary abundance without economic vitality. Trillions in newly created liquidity circulated endlessly within the financial system, yet failed to translate into proportional gains in real output. Money moved faster on screens than it did through factories, supply chains, or wages. The velocity of money declined, even as the quantity exploded. This was the first warning sign of a deeper malfunction. Liquidity was no longer stimulating growth because growth was no longer the objective. Stability had replaced progress. Central banks gradually became the primary buyers of sovereign debt, blurring the line between monetary policy and fiscal survival. Governments learned that deficits no longer carried immediate consequences. As long as interest rates remained suppressed, debt servicing costs stayed manageable. Political incentives shifted accordingly. Structural reforms became unnecessary and unpopular. Why confront inefficiencies when borrowing was effectively free? Why risk voter backlash with austerity when liquidity could postpone trade-offs indefinitely? Global markets adapted quickly to this environment. Risk was repriced, not based on fundamentals, but on expectations of intervention. Investors stopped asking whether assets were productive and began asking whether central banks would step in during the next downturn. This created a self-reinforcing feedback loop. The more markets believed in perpetual support, the more leverage they assumed. The more leverage accumulated, the more catastrophic any withdrawal of liquidity would become. Monetary authorities were no longer just managing the economy. They were hostage to it. Meanwhile, the global debt burden climbed relentlessly. Sovereign debt, corporate debt, and household debt all expanded in parallel, tied together by the assumption that refinancing would always be possible. Growth became increasingly dependent on leverage rather than productivity. Economies did not advance, they inflated. Each cycle required larger interventions to achieve diminishing results. Where once a modest rate cut could stimulate demand, now massive balance sheet expansions barely moved real economic indicators. The global news cycle reflected this quiet distortion. Headlines celebrated market resilience, even as manufacturing slowed. Equity rallies occurred alongside declining labor participation. Economic recovery was declared repeatedly, yet median income stagnated. The contradiction became structural. Markets thrived in an environment that ordinary economic activity could no longer recognize as healthy. Liquidity insulated financial assets from reality, while the real economy absorbed the consequences in the form of inequality, fragility, and declining trust. What emerged was a system addicted to liquidity, not because it produced prosperity, but because it prevented collapse. Money stopped being a tool for growth and became a sedative. Each new injection calmed markets temporarily, while weakening the underlying organism. Capital allocation deteriorated. Inefficient firms survived. Productive risk-taking declined. The economy became less dynamic, less innovative, and more dependent on continuous intervention. This was the true beginning of the Great Liquidity Trap. Not a sudden event, but a gradual realization that money alone could no longer generate real progress. Liquidity could inflate prices, suppress volatility, and delay pain, but it could not restore productivity or confidence. The system continued to function, but it no longer healed itself. Growth became cosmetic, stability artificial, and risk invisible until it suddenly was not. By the time this reality became undeniable, the architecture of endless money was already too large to dismantle easily. The world had built an economic order in which liquidity was everywhere, yet meaningful growth was increasingly rare. The question was no longer whether money could save the system, but how long the system could survive once money lost its power to do so. The moment cheap money stopped working did not arrive with panic or headlines. It arrived quietly, disguised as stability. Interest rates were near zero, liquidity abundant, credit widely available. Yet something fundamental had changed in how the economy responded. Traditional monetary theory assumed a simple chain reaction. Lower rates would reduce borrowing costs, cheaper credit would stimulate investment and consumption, demand would rise, and growth would follow. For decades, this logic held. Then, gradually, it began to fail. Businesses no longer reacted to cheap money by expanding productive capacity. Instead of building factories, hiring workers, or investing in research, corporations increasingly chose financial maneuvers. Share buybacks exploded, not because companies lacked opportunities, but because financial markets rewarded immediate price appreciation over long-term growth. Executives were incentivized to optimize balance sheets rather than innovate. Cheap money turned risk-taking inward, not outward. Capital circulated within corporations and markets instead of flowing into the real economy. Consumers, too, changed their behavior. Low interest rates were supposed to encourage spending, yet households became more cautious. Wage growth lagged behind asset inflation. Job security became less certain. The cost of housing, healthcare, and education climbed faster than incomes. Even as credit was cheap, confidence eroded. People borrowed to survive, not to advance. Consumption shifted from discretionary expansion to debt maintenance. Cheap money no longer felt like opportunity. It felt like a trap. Banks played a critical role in this breakdown. After successive crises, regulatory pressure increased. Risk models tightened, and lending standards became more conservative. Liquidity injected by central banks accumulated on bank balance sheets or returned to central bank facilities, rather than reaching small businesses or productive investment. Money existed in vast quantities, but it failed to circulate where it mattered most. The plumbing of the financial system remained intact, yet the flow was misdirected. This phenomenon became visible in the declining velocity of money. Despite unprecedented expansion of monetary supply, each unit of currency moved through the economy fewer times. It lingered in reserves, financial assets, and speculative instruments. Economies appeared liquid but functioned sluggishly. Growth rates flattened even as intervention intensified. This contradiction exposed a critical truth. Liquidity is not the same as demand. Money can be created instantly, but trust and confidence cannot. Central banks responded by doubling down. When rate cuts failed to stimulate growth, unconventional tools were introduced. Forward guidance attempted to shape expectations. Asset purchase programs expanded into new territories. In some regions, negative interest rates emerged, effectively charging institutions for holding excess reserves. The goal was to force money into circulation. Instead, it reinforced defensive behavior. Institutions became more cautious, not more aggressive. Risk aversion deepened under the weight of persistent uncertainty. Global markets interpreted these actions not as signals of strength, but as signs of fragility. Each intervention confirmed that organic growth was insufficient. Investors learned to anticipate rescue rather than recovery. Monetary policy became a permanent support mechanism rather than a temporary stimulus. The economy adjusted accordingly. Businesses delayed restructuring. Governments postponed reform. Financial actors optimized for central bank behavior rather than economic fundamentals. Economic data began to reflect this stagnation beneath the surface. Productivity growth slowed across advanced economies. Capital expenditure as a share of output declined. New business formation weakened. Even technological advancement failed to translate into broad-based productivity gains. Innovation existed, but its economic impact was diluted by structural inefficiencies and financial distortions. Cheap money supported valuation, not transformation. The labor market told a similar story. Employment figures appeared strong, yet quality deteriorated. Wage growth remained subdued. Job polarization increased, with growth concentrated in low-paying service roles and high-skill niches, while middle-income positions eroded. Cheap credit sustained consumption temporarily, but it did not restore upward mobility. Economic participation expanded in form, but not in substance. At the global level, the effects compounded. Capital flowed freely across borders in search of yield, inflating asset bubbles in emerging markets while destabilizing currencies and trade balances. Cheap money in one region became volatility in another. Monetary policy lost its domestic focus and became a global force, transmitting distortions across interconnected financial systems. Stability in one market often meant fragility elsewhere. World news increasingly reflected this imbalance. Stock markets surged on announcements of stimulus, while manufacturing indices softened. Bond yields collapsed even as debt issuance accelerated. Economic optimism was fueled by liquidity, not output. Each rally depended less on earnings and more on expectations of continued support. Markets were no longer discounting future growth. They were discounting future intervention. This was the point at which cheap money ceased to be a stimulus and became a signal of exhaustion. The tools designed to encourage growth now merely prevented contraction. Monetary policy had reached diminishing returns. Each additional unit of liquidity produced less real activity than the last. The economy responded not with expansion, but with dependence. The system entered a state where withdrawal of support was impossible without triggering instability, yet continuation guaranteed stagnation. Cheap money no longer solved problems. It postponed them. It masked structural weakness while amplifying long-term risk. Growth became fragile, confidence conditional, and stability artificial. The mechanism that once powered recovery had lost its force, leaving the global economy suspended between motion and paralysis. This was not a temporary anomaly, it was a structural shift. The world had crossed a threshold where monetary easing no longer unlocked growth, only delayed reckoning. Liquidity still mattered, but its role had changed. It could calm markets, compress yields, and suppress volatility, but it could not revive the engine of real economic expansion. The realization spread slowly, but its implications were profound. The era of effective cheap money was ending, even as the world depended on it more than ever. The deeper consequences of this breakdown became clearer as time passed. What initially looked like a temporary inefficiency revealed itself as a structural transformation in economic behavior. Cheap money altered incentives so thoroughly that reversing course became politically, financially, and socially dangerous. Entire business models were built on the assumption that capital would remain abundant forever. Governments structured budgets around perpetual refinancing. Households adjusted expectations to an environment where asset inflation replaced income growth as the primary source of perceived wealth. One of the most damaging effects was the distortion of price signals. Interest rates traditionally functioned as the price of time and risk, guiding capital toward its most productive use. When rates were compressed for years, that signal was effectively erased. Capital allocation lost discipline. Projects that would have been rejected under normal conditions received funding. Marginal ventures survived. Truly innovative but risky initiatives struggled to compete with leveraged financial strategies that promised faster, safer returns. Cheap money did not eliminate risk, it hid it. This distortion was especially visible in corporate debt markets. Issuance expanded rapidly, not because firms needed capital for expansion, but because borrowing was cheaper than restraint. Companies refinanced again and again, extending maturities without reducing leverage. Balance sheets grew heavier, yet vulnerability increased. Earnings growth slowed, but debt obligations accumulated quietly in the background. The system appeared stable precisely because nothing was being resolved. Equity markets reflected this illusion with remarkable clarity. Valuations climbed, even as underlying fundamentals weakened. Price-to-earnings ratios expanded, justified by low discount rates rather than strong growth prospects. Investors accepted lower expected returns in exchange for perceived safety, trusting the central banks would intervene if volatility returned. Risk premiums compressed across asset classes. The market became less sensitive to bad news, not because conditions improved, but because intervention was assumed. At the same time, savers paid the hidden cost of cheap money. With yield suppressed, traditional saving lost meaning. Retirement systems faced growing strain as expected returns fell below required levels. Pension funds increased exposure to riskier assets to meet obligations. Insurance companies struggled to match long-term liabilities with safe yields. What began as a policy to stimulate demand gradually undermined the foundations of long-term financial stability. The real economy continued to absorb the consequences. Small and medium-sized enterprises, which historically drive job creation and innovation, found themselves squeezed. They lacked direct access to capital markets and depended on bank lending that became increasingly cautious. Liquidity existed, but it flowed upward toward large institutions and asset owners, rather than outward toward productive activity. Economic dynamism weakened as concentration increased. Internationally, the divergence intensified. Countries with reserve currencies benefited disproportionately from cheap money, exporting volatility to the rest of the world. Emerging markets experienced cycles of inflows and sudden reversals as global liquidity conditions shifted. Exchange rates became unstable. Debt denominated in foreign currencies grew more dangerous. Monetary policy in advanced economies increasingly dictated financial conditions globally, regardless of local economic realities. World events repeatedly exposed this fragility. Each hint of policy tightening triggered market stress. Each attempt to normalize rates was met with sharp correction. Central banks learned that even modest tightening risked destabilizing markets addicted to liquidity. Policy became reactive, not proactive. Fear of disruption replaced confidence in recovery. The system could not move forward without pain, yet could not remain still without decay. Public trust eroded quietly. People sensed that markets were disconnected from lived experience. Rising indices did not translate into improved security or opportunity. Housing became less affordable. Wealth concentrated further. Economic narratives diverged from reality on the ground. Cheap money supported headlines of growth, but everyday life felt increasingly constrained. This disconnect fueled social tension and political volatility. The paradox reached its peak when stimulus announcements no longer generated optimism, only relief. Markets rallied not because of opportunity, but because disaster had been postponed again. Each intervention bought time, but at a rising cost. Expectations adjusted downward. Growth targets were revised. Normal became synonymous with stagnation. The economy functioned, but without momentum. This marked the final stage of cheap money's effectiveness. It no longer encouraged risk-taking, it enforced dependence. It no longer accelerated growth, it slowed decay. Monetary policy lost its creative power and became a maintenance tool. The system survived, but it did not evolve. Productivity gains remained elusive. Innovation struggled to overcome structural inertia. Confidence became conditional and fragile. By this point, the global economy was no longer responding to incentives. It was responding to fear. Fear of tightening, fear of volatility, fear of correction. Cheap money had reshaped behavior so deeply that removing it threatened collapse, yet continuing it guaranteed long-term stagnation. This was the essence of the liquidity trap in its modern form. Money still existed in abundance, but its capacity to change outcomes had diminished. The mechanism that once transformed liquidity into growth was broken. The world had not run out of money. It had run out of ways for money to matter. The rise of the zombie economy did not begin with failure, but with survival. In an environment saturated with cheap money, the definition of success quietly changed. Companies no longer needed to be profitable, innovative, or efficient to remain alive. They needed only one thing: access to financing. As long as credit was cheap and refinancing was easy, weakness could be hidden, losses could be rolled forward, and inefficiency could be sustained indefinitely. What emerged was an economic ecosystem where survival replaced progress. Zombie companies are not dramatic collapses or scandals. They are firms that generate just enough cash flow to service interest payments, but not enough to meaningfully reduce principal or invest in future growth. Under normal market conditions, such firms would either restructure or exit, freeing capital and labor for more productive use. In a world of endless liquidity, they linger. Cheap money removes the pressure of creative destruction, turning the market into a holding pen for inefficiency. The scale of this phenomenon expanded rapidly as monetary policy became more aggressive. Low interest rates reduced the cost of debt to levels that made refinancing easier than reform. Corporations discovered that it was cheaper to borrow again than to confront structural problems. Loss-making divisions were kept alive. Outdated business models persisted. Productivity stalled, not because innovation disappeared, but because capital was trapped in unproductive structures that refused to die. Economic data began to reflect this distortion. Corporate leverage ratios increased across advanced economies, even as revenue growth slowed. Debt-to-earnings metrics deteriorated quietly, masked by low interest expenses. Balance sheets looked stable on the surface, but resilience declined beneath. Firms became increasingly sensitive to even small changes in financial conditions. A system filled with zombies appears calm, but it is inherently fragile. This fragility spread unevenly across sectors. Industries with high capital intensity and low margins became especially dependent on cheap credit. Retail, traditional manufacturing, energy, and transportation all saw waves of firms survive despite declining competitiveness. Rather than investing in modernization, many focused on financial survival. Employment was maintained in form, but not in quality. Jobs existed, but wage growth stagnated. Productivity gains evaporated. The presence of zombie firms distorted competition. Healthy companies faced unfair pressure from rivals that could underprice or oversupply thanks to artificially low financing costs. Market signals broke down. Efficiency was no longer rewarded consistently. Innovation slowed, not because talent vanished, but because capital allocation became irrational. Resources remained locked in firms that should have exited, crowding out those that could drive future growth. Banks and investors played a central role in sustaining this environment. Faced with low yields elsewhere, lenders preferred refinancing weak borrowers over recognizing losses. Extending credit became a strategy of risk avoidance rather than risk taking. Losses were deferred, not resolved. Credit quality declined gradually, spread across balance sheets in ways that made it difficult to isolate and confront. The system optimized for delay. Equity markets reinforced the illusion. Zombie firms often saw their share prices supported by general market liquidity rather than firm-specific performance. Index inclusion protected them. Passive investment flows reduced scrutiny. Valuations became less connected to fundamentals and more to macro conditions. As long as liquidity remained abundant, survival itself became a form of success. At the macro level, the zombie economy imposed a hidden tax on growth. Capital trapped in unproductive firms reduced overall efficiency. Labor mobility declined as workers remained in stagnant roles rather than transitioning to expanding sectors. Aggregate productivity growth slowed across entire economies. This was not a coincidence, but a direct consequence of suppressing failure. Without exit, there could be no renewal. Global news increasingly hinted at this stagnation. Productivity figures disappointed year after year. Growth forecasts were repeatedly revised downward. Economies expanded, but at a slower and more fragile pace. Each cycle depended more on credit than on output. Each recovery was weaker than the last. Policymakers spoke of resilience, but the underlying structure grew more brittle. The zombie economy also reshaped corporate culture. Management priorities shifted toward financial engineering and survival tactics. Long-term strategy gave way to short-term liquidity management. Innovation budgets were trimmed. Risk was avoided, not embraced. Companies learned to operate in a state of permanent fragility, sustained by external support rather than internal strength. This environment bred complacency and fear simultaneously. Complacency, because failure seemed unlikely as long as liquidity remained. Fear, because everyone understood that survival depended on conditions beyond their control. A slight tightening of credit, a shift in policy, or a loss of confidence could trigger collapse. Stability existed, but it was conditional and reversible. By sustaining zombie firms, the system traded short-term calm for long-term decay. Growth potential eroded quietly. The economy continued to function, but with diminishing vitality. Each year of survival without restructuring made eventual adjustment more painful. The longer inefficiency persisted, the greater the accumulated cost. The rise of the zombie economy was not an accident or an anomaly. It was the logical outcome of a system that prioritized liquidity over discipline. Cheap money did not simply support weak firms. It transformed weakness into a viable business model. Survival became detached from performance. Failure lost its corrective function. This marked a profound shift in how capitalism operated. Markets no longer cleared efficiently. Resources no longer flowed freely toward productivity. The economy became heavier, slower, and more dependent on continuous support. Zombies did not dominate headlines, but they quietly reshaped the foundation of global growth. What appeared to be stability was in reality stagnation disguised by liquidity. The system avoided collapse by refusing to let go of the past. In doing so, it sacrificed the future. As the zombie economy expanded, its effects became impossible to isolate. What began as a corporate phenomenon gradually infected entire financial ecosystems. Markets adapted to the presence of firms that should not exist, pricing assets as if inefficiency were permanent rather than temporary. This normalization of weakness altered expectations across every layer of the economy. Growth projections became conservative. Risk tolerance declined. Long-term planning gave way to short-term survival strategies that assumed stagnation as the baseline. One of the most dangerous consequences was the accumulation of hidden systemic risk. Zombie firms do not fail loudly in isolation. They fail together when conditions change. Because they depend on constant refinancing, even minor shifts in credit availability can trigger cascading defaults. The system appears stable precisely because stress is suppressed. But stability without resilience is an illusion. When pressure finally arrives, it arrives everywhere at once. This risk is amplified by interconnected balance sheets. Banks, pension funds, insurance companies, and asset managers all hold exposure to weak firms through bonds, loans, and equity instruments. Because these firms have survived for years, their presence is deeply embedded in portfolios assumed to be diversified and safe. Credit ratings lag reality. Accounting practices obscure vulnerability. Losses accumulate invisibly, spread thinly across institutions until they are impossible to disentangle. Global financial news occasionally offers glimpses of this fragility. Debt downgrades appear suddenly. Entire sectors struggle to refinance at once. Markets react sharply to small policy signals, not because the signals are dramatic, but because the margin for error has vanished. When so many firms survive only by rolling debt, the system loses tolerance for even modest tightening. The zombie economy also reshapes innovation in subtle but profound ways. Capital that should fund new technologies and business models is instead consumed by maintaining obsolete ones. Startups face higher barriers to entry, not because ideas are scarce, but because incumbents refuse to exit. Productivity-enhancing disruption slows. Technological progress continues, but its diffusion into the broader economy weakens. Innovation becomes concentrated rather than transformative. Labor markets reflect this stagnation. Workers remain employed but trapped. Skills stagnate. Mobility declines. The promise that failure creates opportunity breaks down. Younger generations enter economies dominated by firms that offer stability without advancement. The social contract erodes quietly as effort becomes less correlated with reward. Economic participation increases in form, but not in quality. At the policy level, the zombie economy creates a false sense of control. Governments point to low unemployment and stable output as evidence of success. Yet these indicators mask underlying decay. Growth exists, but it is shallow. Employment exists, but it is fragile. Stability exists, but it is borrowed from the future. Policymakers become reluctant to confront the problem because any attempt to restore discipline threatens immediate disruption. This reluctance extends internationally. Countries fear being the first to tighten conditions, knowing that global capital will flee. Monetary policy becomes synchronized by fear rather than coordination. Each economy maintains loose conditions not because it is optimal, but because deviation appears dangerous. The result is a global equilibrium of weakness, where no one moves because everyone depends on everyone else not moving. The zombie economy also distorts political incentives. Leaders prefer liquidity-driven calm over reform-driven volatility. Structural changes that could improve productivity are postponed because their short-term costs are visible, while the long-term benefits are uncertain. Cheap money becomes a substitute for leadership. Delay becomes policy. Time is bought repeatedly, even as the bill grows larger. As years pass, the cost of maintaining zombies increases. Each refinancing extends fragility. Each postponed restructuring deepens imbalance. The system becomes less flexible, less adaptive, and more brittle. When shocks occur, they propagate faster because buffers have been consumed by years of artificial survival. Resilience has been traded for continuity. The greatest danger lies not in the existence of zombie firms themselves, but in what they represent. They signal that the economy has lost its ability to self-correct. Failure, once a mechanism of renewal, is now treated as a threat to be avoided at all costs. Without failure, learning slows. Without exit, entry declines. Without pressure, progress fades. By sustaining zombies, the system delays collapse, but guarantees stagnation. Growth potential erodes incrementally, unnoticed by those focused on quarterly indicators. The economy continues to function, but its capacity to improve diminishes year by year. What remains is an economy that survives, but no longer advances. This is the paradox at the heart of the zombie economy. It preserves the appearance of stability while hollowing out its foundation. It reduces volatility today by increasing vulnerability tomorrow. It keeps firms alive by weakening the system that supports them. In doing so, it transforms liquidity from a tool of growth into an instrument of decay. The longer this condition persists, the more painful the eventual adjustment becomes. When the cycle finally turns, zombies do not fall one by one. They collapse together, and when they do, the damage extends far beyond the firms themselves, reaching banks, workers, governments, and markets simultaneously. What was once an emergency measure has become a permanent condition. The zombie economy is not a side effect of modern monetary policy. It is its most revealing outcome. The widening gap between financial markets and society did not emerge from a single crisis. It formed gradually, layered year after year, as liquidity reshaped incentives and distorted signals. Markets climbed while everyday life grew heavier. Asset prices surged while purchasing power stagnated. On the surface, prosperity appeared intact. Beneath it, the foundations of shared economic progress weakened. Financial markets responded exactly as the system trained them to respond. When liquidity was abundant and rates were suppressed, discount rates collapsed. Future earnings, however uncertain, appeared more valuable. Valuations expanded far beyond historical norms. Equity indices reached record levels even as growth slowed. Capitalization increased, not because companies produced more, but because money had fewer alternatives. Markets became reflections of monetary conditions rather than mirrors of economic reality. This divergence was reinforced by structural changes in investing. Passive funds and index tracking absorbed massive inflows. Capital allocation became automatic rather than analytical. Companies benefited from inclusion rather than performance. Liquidity lifted entire markets indiscriminately, rewarding scale over efficiency. The market stopped asking whether firms deserved capital and focused instead on whether they were large enough to receive it. Meanwhile, the real economy followed a different trajectory. Productivity growth declined across advanced economies. Real wages failed to keep pace with asset inflation. Employment expanded in quantity, but not in quality. Many jobs offered stability without advancement. The promise that participation would lead to upward mobility weakened. Economic growth existed statistically, yet felt increasingly inaccessible. Housing became the most visible symbol of this divide. Low interest rates pushed real estate prices higher, transforming homes into financial assets rather than places to live. Ownership drifted out of reach for younger generations. Rent consumed a growing share of income. Wealth accumulated passively for those who already owned assets, while those without capital faced rising barriers. Liquidity inflated wealth unevenly, concentrating gains at the top. This pattern extended beyond housing. Equity ownership remained concentrated. Pension funds and institutional investors benefited from rising markets, yet individuals faced declining security. Retirement systems grew more fragile as returns became dependent on continued asset inflation. The system required markets to rise not to generate prosperity, but to avoid collapse. Financial success became less about productivity and more about positioning within the liquidity cycle. Economic statistics struggled to capture this imbalance. Headline indicators suggested strength. Unemployment appeared low, market volatility remained contained. Yet beneath these aggregates, strain accumulated. Labor participation declined in subtle ways. Household debt increased. Savings eroded. Growth became fragile, dependent on confidence rather than income. Stability relied on sentiment, not substance. Global news increasingly reflected this contradiction. Markets rallied on central bank reassurance even as manufacturing surveys weakened. Bond yields fell despite rising debt issuance. Currency markets reacted more to policy language than trade flows. Financial conditions loosened while real activity softened. The signal became clear. Markets no longer priced the economy, they priced intervention. This dynamic reshaped public perception. People sensed that markets were no longer aligned with lived experience. Rising indices did not translate into improved opportunity. Economic narratives diverged from reality on the ground. Trust eroded quietly. Institutions appeared distant. Policy responses felt abstract. Growth became something observed, not felt. The concentration of wealth accelerated these tensions. Asset inflation disproportionately benefited those with exposure to financial markets. Liquidity amplified inequality not through malice, but through structure. Money flowed where assets already existed. Returns compounded for those positioned to receive them. Those dependent on labor income fell behind. The gap widened gradually, then visibly. At the corporate level, this divergence influenced behavior. Companies prioritized shareholder returns over wage growth. Buybacks outpaced investment. Capital rewarded financial efficiency rather than productive expansion. Markets applauded cost-cutting even when it weakened long-term capacity. The incentives were clear. Value creation was measured by price, not progress. This separation between markets and society also weakened political consensus. Economic policy became harder to justify. Growth narratives lost credibility. Populist pressure increased as people questioned who the system served. Markets appeared protected while households absorbed volatility. Liquidity stabilized finance, but failed to stabilize expectations. Confidence fractured along economic lines. Internationally, the divide manifested differently, but consistently. Countries integrated into global capital markets saw asset inflation without commensurate income growth. Emerging economies faced volatility as capital flowed in and out, chasing yield rather than development. Monetary conditions set in one region reshaped social outcomes in another. Financial integration magnified divergence rather than smoothing it. The longer this gap persisted, the more self-reinforcing it became. Markets assumed support and priced accordingly. Policymakers feared correction and hesitated to withdraw liquidity. Society adjusted expectations downward. Growth was no longer expected to improve conditions broadly. It was expected merely to sustain the system. This marked a fundamental shift in capitalism's social contract. Markets rose, but legitimacy declined. Wealth accumulated, but trust dissipated. Liquidity produced stability at the top and fragility below. The economy continued to function, but cohesion weakened. What made this divergence dangerous was not inequality alone, but disconnection. Markets ceased to reflect collective progress. They reflected monetary abundance. When financial success becomes detached from social outcomes, instability follows. Confidence becomes conditional. Support erodes. The system appears strong, yet grows increasingly vulnerable. This was the environment in which markets thrived while society struggled. A system optimized for financial performance drifted away from the foundations of real economic health. Liquidity lifted prices, but it did not lift lives. As this separation deepened, the feedback loop between markets and society grew increasingly unstable. Financial markets depended on public confidence and institutional legitimacy, yet their behavior steadily undermined both. The more markets rose without broad economic improvement, the more detached they appeared. This detachment altered how people understood risk, reward, and fairness. Economic success no longer felt earned through productivity or effort, but granted through proximity to capital. This perception mattered because modern economies are not sustained by numbers alone. They are sustained by belief. Workers accept delayed gratification when they believe opportunity exists. Consumers spend when they trust future income. Investors commit capital when they believe growth is real. As markets divorced themselves from everyday experience, that belief weakened. Confidence did not collapse suddenly. It thinned gradually, eroded by inconsistency between headlines and reality. The political consequences followed predictably. Governments faced growing pressure to address inequality without disturbing markets that had become dependent on liquidity. Fiscal policy expanded as monetary tools lost effectiveness. Deficits widened, justified by low borrowing costs and the need to support households left behind by asset-driven growth. Yet fiscal expansion increasingly served to offset structural weakness rather than resolve it. Public spending filled gaps, but it could not restore alignment between markets and society. Central banks found themselves in an impossible position. With markets conditioned to constant support, any hint of tightening risked sharp corrections. Yet maintaining loose conditions reinforced inequality and asset dependence. Policy choices narrowed. Stability became synonymous with continuation. Each intervention preserved calm while deepening the underlying divide. Markets responded positively. Society responded with skepticism. Economic data reflected this imbalance in subtle ways. Consumption patterns shifted toward essentials. Discretionary spending became sensitive to shocks. Household balance sheets grew more fragile despite rising aggregate wealth. Savings rates fluctuated not with confidence, but with fear. Growth became increasingly reactive, driven by stimulus rather than momentum. The labor market illustrated the tension vividly. Employment remained high in aggregate, yet job satisfaction declined. Wages lagged productivity in sectors tied to capital markets. Bargaining power weakened. Workers remained employed but uncertain. The promise of advancement faded, replaced by a focus on security. Economic participation continued, but aspiration diminished. Markets, however, interpreted stability as success. Low volatility reinforced confidence in the system's durability. Asset prices incorporated perpetual support. Risk models adjusted accordingly. Investors became less sensitive to downside scenarios, assuming intervention would limit losses. This complacency reduced resilience. The system grew more exposed, precisely because it appeared calm. International dynamics intensified these pressures. Countries with strong financial markets attracted capital, even as social tensions rose. Those without such markets faced volatility and constraint. Global inequality widened alongside domestic inequality. Monetary conditions transmitted through capital flows shaped outcomes far from their origin. Financial integration amplified divergence across societies as well as within them. Global news cycles increasingly highlighted this contradiction. Market rallies followed policy reassurances, even as protests, strikes, and political fragmentation spread. Economic indicators improved, while social indicators deteriorated. The disconnect became visible, yet difficult to address. Markets required liquidity. Society required opportunity. Policy struggled to deliver both. The long-term risk was not immediate collapse, but gradual destabilization. When markets no longer reflect shared prosperity, their legitimacy erodes. Support becomes conditional. Trust declines. Political pressure mounts. Financial systems depend on stability, but stability depends on consent. Liquidity can suppress volatility, but it cannot restore belief. As years passed, this imbalance hardened into structure. Asset ownership defined security. Labor income defined vulnerability. Growth narratives shifted from inclusion to endurance. The economy no longer promised improvement, it promised survival. Markets thrived within this framework, but society adapted reluctantly. This adaptation carried its own costs. Innovation slowed as risk tolerance declined. Entrepreneurship narrowed to those with access to capital. Social mobility weakened. Economic dynamism faded quietly. The system continued to function, but its capacity to renew itself diminished. Ultimately, the separation between markets and society created a fragile equilibrium. Markets required constant support to sustain valuations. Society required constant reassurance to tolerate inequality. Policy delivered both through liquidity and stimulus, but neither addressed the root cause. Alignment was postponed, not restored. This was the critical danger of the divergence. Not that markets rose, but that they rose alone. Liquidity elevated prices while hollowing out trust. Stability was achieved at the expense of cohesion. The economy moved forward financially while standing still socially. In such an environment, shocks do not need to be large to be disruptive. When belief is thin, even small disturbances can cascade. Markets may remain liquid, but legitimacy dries up. The system survives on intervention rather than confidence. The world entered a phase where financial success no longer guaranteed social stability. Markets were strong, society was strained. And the longer this imbalance persisted, the more uncertain the future became. The final illusion of the modern monetary era was the belief that there would always be another lever to pull. For decades, every slowdown was met with a response. Rates were cut, liquidity was expanded, balance sheets grew, confidence returned. Each cycle reinforced the conviction that monetary authorities possessed infinite tools and infinite credibility. What was never fully confronted was the finite nature of effectiveness. Power was mistaken for capacity. Intervention was mistaken for control. By the time the global economy entered its current phase, the traditional mechanisms of monetary salvation were already exhausted. Interest rates hovered near their effective lower bound across major economies. Balance sheets had expanded to levels that blurred the boundary between central banking and fiscal policy. Debt burdens reached historical extremes, not as temporary anomalies, but as structural features of the system. The tools remained visible, but their impact diminished. This reality became evident in the changing market reaction to policy. Announcements that once sparked optimism now produced only relief. Markets no longer interpreted stimulus as a signal of growth, but as confirmation of weakness. Each intervention reassured investors that collapse had been postponed, not that recovery was imminent. Expectations adjusted downward. Stability replaced expansion as the objective. Economic statistics reinforced this shift. Growth persisted, but at lower rates. Productivity remained subdued. Investment lagged despite favorable financial conditions. The marginal return on liquidity approached zero. Where previous cycles required modest intervention, the current system demanded ever larger actions to maintain equilibrium. Monetary policy became asymmetrical. It could respond to crises, but it could not generate momentum. Governments stepped deeper into the gap. Fiscal expansion accelerated as monetary policy lost traction. Deficits widened under the justification of necessity. Public debt expanded alongside private debt. The distinction between emergency measures and normal policy dissolved. Spending sustained demand, but it did not resolve underlying inefficiencies. Growth became managed rather than organic. Global debt figures illustrated the magnitude of the constraint. Sovereign obligations expanded across advanced and emerging economies alike. Corporate leverage reached levels sustained only by low rates. Household debt remained elevated, tied to inflated asset values rather than rising incomes. The system became increasingly sensitive to changes in financing conditions. Even minor increases in borrowing costs threatened disproportionate disruption. Markets internalized this fragility. Volatility declined, not because risk disappeared, but because risk was suppressed. Price discovery weakened. Assets were valued not by cash flow resilience, but by assumptions of support. Risk premiums compressed to levels inconsistent with uncertainty. The system priced perfection because it could not tolerate reality. Central banks found themselves trapped by their own success. Years of intervention had created dependence. Markets, governments, and institutions structure behavior around continued support. Any attempt to normalize policy risks triggering the very instability policy was designed to prevent. Authority became constraint. The power to intervene eliminated the freedom to withdraw. International coordination offered limited relief. Monetary policy divergence threatened capital flight. Currency movements amplified imbalance. Trade tensions intensified as countries sought growth through external adjustment. Global financial integration transmitted stress rapidly. What appeared manageable domestically became volatile globally. The margin for error narrowed everywhere at once. World events repeatedly tested this fragile equilibrium. Supply disruptions, geopolitical tensions, and financial shocks revealed how little buffer remained. Each crisis demanded immediate response. Each response further entrenched dependence. The system survived, but it did not strengthen. Resilience declined as intervention accumulated. The psychological dimension became increasingly important. Confidence depended less on fundamentals and more on reassurance. Markets watched policy language more closely than economic data. Sentiment oscillated with expectations of support. Trust in organic recovery faded. Stability relied on belief in perpetual intervention rather than belief in growth. This shift altered the nature of risk itself. Risk was no longer distributed through cycles of expansion and contraction. It was concentrated in the future. By suppressing volatility in the present, the system accumulated instability over time. The longer adjustment was delayed, the larger its eventual impact became. Risk did not disappear, it migrated. The concept of monetary salvation lost meaning under these conditions. Money could no longer save the system, because the system had been built around money. Liquidity was no longer an external remedy, it was embedded. Additional liquidity changed prices, not outcomes. It altered timing, not direction. At this stage, policy choices narrowed to uncomfortable alternatives. Continue intervention and accept long-term stagnation, withdraw support and risk abrupt correction. Neither path promised restoration of the previous order. The tools that once ended crises now merely managed decline. The system remained operational, but directionless. This was the true end of monetary salvation. Not a dramatic collapse, but a quiet recognition that money alone could no longer resolve structural imbalance. The mechanisms of growth had shifted beyond the reach of central banks. Productivity, confidence, and innovation could not be printed. They required conditions liquidity could not create. The world stood at the crossroads, defined not by shortage of capital, but by shortage of solutions. The era of monetary dominance had reached its limits. What came next would depend not on intervention, but on adjustment. The system could continue as it was, sustained by increasingly fragile support, or confront the consequences of years of delay. The illusion that money could always save the world had finally begun to fade. What followed this realization was not immediate reform, but hesitation. Systems rarely change when collapse is avoided. They change when avoidance becomes impossible. For a time, the global economy existed in suspension, balanced between intervention and inertia. Policymakers understood the limits of monetary power, yet lacked consensus on alternatives. Markets sensed the fragility, yet continued to operate as if support were guaranteed. Society adjusted expectations downward, accepting stagnation as the price of stability. The longer this state persisted, the more the cost shifted forward. Deferred adjustment accumulated pressure. Structural imbalances hardened. Productivity losses compounded quietly. Capital misallocation became embedded rather than cyclical. The economy did not break, but it aged. Each year of delay reduced flexibility. Each postponed correction narrowed future options. Economic history suggests that systems under such strain eventually change through necessity rather than choice. When monetary tools lose effectiveness, the burden shifts elsewhere. Fiscal policy expands further, stretching public balance sheets. Political pressure intensifies as inequality and stagnation persist. Trade relationships strain as countries seek external solutions to internal weakness. Financial repression becomes tempting as governments attempt to manage debt without growth. Markets, once confident in intervention, begin to price uncertainty differently. Long-term expectations adjust. Risk premiums slowly reemerge. Capital becomes more selective. Liquidity still exists, but it no longer guarantees appreciation. The belief that losses will always be socialized weakens. This transition is rarely smooth. It unfolds through episodes of volatility that test confidence repeatedly. At the core of this shift lies a fundamental truth. Monetary policy can influence conditions, but it cannot substitute for real economic renewal. Growth requires productivity gains. Productivity requires innovation, investment, and efficient allocation of resources. None of these can be forced through liquidity alone. When money becomes abundant without purpose, it loses its transformative power. The next phase of the global economy is therefore defined by constraint rather than expansion. Debt limits restrict policy. Demographics weigh on demand. Geopolitical fragmentation disrupts efficiency. Environmental pressures demand investment without immediate return. The margin for error shrinks. The era of easy solutions ends quietly, replaced by difficult trade-offs. This does not imply inevitable collapse. It implies a prolonged period of adjustment. Growth may continue, but unevenly. Volatility may increase, but episodically. Financial systems may remain intact, but less forgiving. The transition away from monetary dominance will be slow, contested, and politically complex. It will test institutions accustomed to intervention and societies accustomed to avoidance. For investors, this environment demands a rethinking of assumptions. Returns driven by liquidity become unreliable. Valuations require scrutiny. Risk management regains importance. The distinction between price and value reasserts itself. Markets no longer reward passivity alone. Capital must once again discriminate between resilience and fragility. For governments, the challenge is more profound. Restoring growth without relying on monetary shortcuts requires reform, coordination, and credibility. It requires confronting inefficiency, encouraging innovation, and accepting short-term disruption for long-term gain. These choices are difficult precisely because they cannot be deferred indefinitely. Money once bought time. Now time demands decisions. For society, the transition reshapes expectations. Prosperity may arrive more slowly. Security may depend less on asset inflation and more on productive capacity. Trust must be rebuilt through alignment between markets and lived experience. Economic narratives must reconnect with reality. Without this, stability remains fragile, regardless of liquidity. The end of monetary salvation does not mark the end of the economy. It marks the end of illusion. The belief that money alone could override structural limits allowed imbalance to grow unchecked. Its fading opens space for recalibration, but only if acknowledged. Denial prolongs stagnation. Recognition enables change. History rarely announces turning points clearly. They are recognized in hindsight, when old tools no longer work and new ones have yet to take shape. The present moment fits this pattern. Monetary policy still operates, but without dominance. Liquidity still flows, but without direction. Growth still occurs, but without conviction. The world now moves forward under different rules, not governed by scarcity of money, but by scarcity of trust, productivity, and coordination. The Great Liquidity Trap is not a single event, but a condition. Escaping it requires more than stimulus. It requires acceptance that the era of monetary rescue has passed. Money no longer saves the world, because the world has asked it to do what it cannot. What comes next will be defined not by how much liquidity is created, but by how courageously imbalance is addressed. The choice is no longer between growth and collapse, but between adjustment and stagnation. The illusion has ended. The reckoning is gradual, and the future, uncertain but unavoidable, belongs not to money, but to the decisions that replace it. The next crisis will not arrive with panic. It will arrive with silence. No emergency rate cuts, no heroic stimulus, no illusion of rescue. Only a system forced to face the consequences of decades of delay. The question is no longer whether the world will change. The question is who will be ready when it does. Because when money loses its power, only understanding remains an advantage. If you want to see what comes next, if you want to understand the system before it reshapes itself, stay with us. The era of easy money is ending, and the world that follows will not forgive ignorance.